China tariffs at this level are unsustainable, and they really are. I mean, it's not so much the tariffs at this point; it's almost like an embargo from both sides. I mean, nothing's going to move back and forth at these levels. I think Trump is ratings obsessed in my mind. He could probably tell you the ratings of the morning talk shows, and I'm not sure why he knows that. But I think the stock market is a good ratings mechanism for him, and the economy will be a good ratings mechanism for him.
Have the tariffs started to impact the economy in a meaningful way? We'll start to examine the labor market. We'll start to examine inflation, and we'll start to examine market movements up to today, beginning of May, with our next guest, Chip Rewey. He's a CIO of Rewey Asset Management, an RIA based in New Jersey. We'll be talking about his views for not just economic growth of the markets and where investors should go. He has a very interesting asset allocation outlook for us. Thank you, Chip, for joining the show. Welcome to the program.
Hi, David. Thank you for having me.
I want to start by talking about today's jobs numbers. So this came in on Friday, May the 2nd. U.S. payroll growth totals 177,000 in April, defying expectations. Non-farm payrolls increased seasonally just 177,000 for the month, slightly below the downwardly revised 185,000, but above the Dow Jones estimate for 133,000. The unemployment rate stayed at 4.2% as expected, indicating that the labor market is holding relatively stable. Average hourly earnings rose just 0.2% for the month, below the 0.3% forecast. This came as weekly jobless claims rose by a lot more than expected just this week. So a little bit of conflicting data, though. Markets today soaring on perhaps this news and other things. The S&P is up 1.2%. The Nasdaq's up 1.3%. Gold's up 1.5%. And Bitcoin is inching towards $100,000 again. Interestingly, the dollar is sliding and yields are up. And so I'm just wondering how you're interpreting market movement right now. Is this the beginning of a V-shaped recovery here for the markets?
Well, I think we've had a V-shaped recovery, right? The NASDAQ was up in April. I mean, crazy enough, right? I mean, we had terrible days right after Liberation Day. On the jobs report specifically, it's a little trailing looking. It's a short period. And, any of your listeners and you who've worked for a company, a 30-day period is incredibly short. Getting meetings on the calendar and taking action, it takes a week or so, right? So I wouldn't have expected huge job numbers to fall. I think tariffs will have an impact, but I think there's also a period of pause because a lot of the tariffs are being rolled back. And why the full amount can be damaging, and even the China tariffs that are on right now can be damaging, it's a different scenario than the COVID crisis. It's a different scenario than the great financial recession of 2007 to 2009. Tariffs are self-inflicted, meaning they can be unself-inflicted quickly. And we've seen that. We've seen the rollback and suspension of the reciprocal tariffs. We're at a 10% base level. The administration's already said a deal with India is done, and that's pretty important. And then potentially other deals will fall in line. And I think people who think, oh, it'll take a while to sign a deal, yeah, it might, but it's the announcement, right? I mean, if a bank buys another bank, it's the announcement. It's not the closing a year later. So it'll be the announcement of deals that moves market, not the signing. So it might take a while to write the contract up on some of these deals, but I think the announcements are important. So back to the jobs number, I wouldn't have expected it to be radically off expectations. The economy is still pretty solid. We came into the year kind of before the tariffs expecting a soft landing scenario, somewhere in the 2 to 3% GDP range. And, what we didn't talk about is the GDP report yesterday down 30 basis points for the first quarter. Well, lies, damn lies, and statistics, the net exports was a negative 4.8, which was astounding. And if you take, and that's usually pretty close to zero. And if you take that out, the GDP would have been up around 4.5. Now, about 2.3% of those imports were gold, and you mentioned gold, which is crazy, and that's a non-productive asset. But the other 2.5 of the net imports might be pre-buying ahead of tariffs. that should work its way back into the economy as those goods move through inventories and sales in later periods. And then the Atlanta Fed GDP has a forecast for 2.4 for the second quarter. So, we could have been, however you want to slice and dice it, adjusted GDP between 2 and 4 for the first quarter. And the outlook is over 2 for the second quarter. That might change. But given the jobs report, I think it shows the economy is coming into this tariff battle on very solid footing.
You said that the tariffs can be undone, which is true from a policy perspective. At any point, they can be removed, but there's still 10% broad-based tariffs on some countries, and there's still, USMCA, and there's still 145% tariffs on China. I'm just wondering if anything that has already been done has already caused irreparable damage to any particular sectors within the economy, and as well, perhaps it's signaled such a downturn for consumers that consumers are less likely to spend money now, given the higher expectations of higher inflation from tariffs. And so that feeds into a self-fulfilling prophecy of less spending and thus an economic slowdown.
Yeah, so 2 points there. Damage and uncertainty. And, the tariffs are causing uncertainty. There's no other way to describe it. And the market doesn't like uncertainty. And that's the reason we've seen pressure in the market. The market likes clarity. Get me a 10-year DCF model. Whether the inputs are good or not, I can feel certain about it. If you don't know what the next 90 days bring, you don't have certainty. DCF models are kind of worthless. And so that's why the markets are skittish and moving around on every sort of announcement or tweet or what have you. On the damage point, that's exactly right. I don't think any irreversible damage has been done yet. And we had the move in the 10-year that scared a lot of people. Yet that was blamed through the media kind of on China and other international countries. And my sense is that was U.S. hedge funds and BDCs kind of caught off sides or de-risking. And we've seen the 10-year come all the way back down from those stress levels. So the bond market clearly isn't broken. The 10-year is well under on the yield basis where we started at the beginning of the year. And again, the GDP and the employment numbers look healthy. What I'm seeing through earnings quarter to date are companies that are taking two roads. Either one saying we're really not going to talk about the impact of tariffs because it's uncertain, or two, here's kind of what a worst case would be. And that the worst case can be undone over time because you can shift your supply base, maybe do some pricing, maybe cut some costs, maybe change suppliers. And, I think what I'm looking for are companies that learned from COVID. The supply chain ground to a halt during COVID, and every company saw their vulnerabilities. I think first quarter 25, we're learning which management teams were great versus good and fix those problems. And we're seeing it. And we're seeing companies that have moved production out of China into India and Malaysia, sourced into the US, brought in their supply chain, rewritten contracts for real-time pricing. And, it's a positive in a way if you can find management teams that have spent the last 5 years looking through their business and strengthening it versus whistling past the graveyard.
Okay. Any specific sectors that you would overweight in light of uncertainty? And I stress uncertainty because we don't know if tariffs are going to be undone, like you said. So I don't want to say a tariff on investment strategy because that may not be applicable in 6 months. Let's say an uncertainty-filled market. What do you do in that situation?
Yeah, what has been surprising to me through earnings season so far is the healthcare sector. Typically, you would think that is resilient, but especially on the product side, they've got a lot of global manufacturing exposure. Places like Costa Rica and China, so that there is a pretty big tariff impact for product companies across the board. And I've been surprised by that somewhat. And now the companies are holding in, they're down a bit, but nothing dramatic. But it's not as resilient as we had seen. A place that I have been looking for to go where I can see some visibility is aerospace and defense.
Mm.
And unfortunately, the world we live in right now, defense spending looks pretty strong. In the continuing resolution, defense spending was up. In the budget that we're working on, the big, beautiful bill, defense spending is up a lot. European NATO, defense spending up a lot. Foreign military sales, today were reported fairly strong year over year. NATO spending, now, whether it's because Russia's active or because they don't think they can count on the US anymore, they're buying. The US needs to replenish what we sent to Israel and what we sent to Ukraine. The US needs to replenish what we left in Afghanistan. And the US needs to rebuild its own inventories for the Taiwan China threat and also for a new warfare reality of drone warfare and anti drone. And that's rippling through lots of companies, and we're seeing strong spending. So, kind of across the board, I see that sector attractive. Now, again, you have to look stock by stock and in my view, evaluate companies one by one. But I see some clarity there. On the commercial side, look, Boeing and Airbus have been their own worst enemies. I mean, Boeing has shut their production through the end of 2024, and now they're recovering. Airbus hasn't been as bad, but they are getting better now. So when you're a patient and you're in the ER and it looks sketchy and they move you into recovery, that's a pretty big uptick. And I think that's where we are right now in commercial. So it's not about going from good to great. It's going from terribly awful to pretty bad, and then kind of bad, and then good, and then pretty good over the next 3 to 4 years. So I think there's a long-term horizon of accelerating commercial builds and deliveries. And in my view, we probably have seen the worst of the production delays, barring, any new radical COVID type impacts or things like that. So I think the aerospace and defense sector on both the aerospace and the commercial side looks like you've got more visibility than most other sectors in the market.
Okay, let's talk about some of these sectors in more detail in just a minute. But your broad market overview, just to finish off on your broad market overview, do you see this recovery continuing? I think is what people want to know.
Well, I do. I listen to Besant a little bit more than Navarro right now. He seems to be in charge. And he's saying that China tariffs at this level are unsustainable. And they really are. I mean, it's not so much the tariffs at this point. It's almost like an embargo from both sides. I mean, nothing's going to move back and forth at these levels. I think both sides want to de-escalate, and there's a lot of face saving that needs to be done. But today, and again, I think it wasn't so much the jobs report today. I think it was recognition that the Trump administration had called China to start trade negotiations. And I think China was a stickler on that point. They weren't going to call first. In my mind, who cares? But if we start negotiating and start dropping some of these worst case tariff scenarios, or at least having exemptions, that can still improve the tariff impact. If we get tariff deals, as I said, it looks like India, they're saying might be close to being baked, then maybe Vietnam, South Korea, and some of the Asian countries first. Look, the EU still hangs out there. And again, the problem, the quote is, who, if I want to call the EU, who do I call? I mean, you've got France, Germany, Italy, et cetera. It should take longer. But I think there is a desire to drop tariffs, either, to the 10% or zero over time. So I think it can get better. And again, the economy is in a decent point. If that doesn't happen, the obvious, I think we could roll over. But I think Trump is ratings obsessed in my mind. He could probably tell you the ratings of the morning talk shows, and I'm not sure why he knows that. But I think the stock market is a good ratings mechanism for him, and the economy. will be a
Yeah.
good ratings mechanism for him. And I don't think he'll tolerate weak data for a while. I think he'll backtrack again. He did this so he can undo it. Um, so yeah, I think we can continue to improve slowly. I think we're off the V bottom. I'm not sure we'll take out past highs, the February highs, until we get more certainty on China and see some deals done. So we're caught in a range, so to speak.
It's interesting what the tariffs have done as a side effect. Unexpectedly, I guess, for the administration, U.S. imports have surged, further widening the trade balance. This is the exact opposite of what Trump and Biden were trying to accomplish in the first place. But anyway, U.S. imports surged more than 40% at an annualized rate in the first quarter. Data showed that drove down GDP. As you know, real GDP came down negative in Q1. Now, businesses are rushing to change their supply chains because, as you know, there's still 145% tariff on China, but tariffs on the EU are a little bit lower. My broader question is, Chip, do you think that we're going to start seeing a shift in the supply chain? And would that change your priorities as a fund manager to invest in certain businesses that are either A, more domestically oriented in terms of their manufacturing, and or B, using supply chains that are not focused on Asia?
So yes, but let's back up. So remember the GDP number down 0.3% in the first quarter. I think it's, lies, damn lies, and statistics. Between gold imports, which shows a healthy consumer and maybe shows a consumer hunkering down, I don't know. But that 2.3% impact to GDP won't work its way back through GDP. I mean, gold, when it's bought, kind of gets stored and that's it. The imports, as you talked about, the 2.5%, so the other part of that 4.8 that was net imports, will work its way back through GDP. And it's kind of a one-off. I mean, if you pre-bought ahead of tariffs, maybe second quarter net exports will be way down and that number will flip back. And maybe that's why the 2.4% estimate for the second quarter looks achievable. So be careful of data points in the short term. But that said, look, the die is cast. I don't think you can be a global manufacturer with the China footprint right now, even if we reach a deal to cut tariffs down to 0 or 10, that isn't looking to diversify the supply chain out of China. I mean, it's where the US has said that's where the biggest issue is. That's where the geopolitical battle is. That's where the economic battle is. And I think we'll see every company, just like I said, since COVID, looking to strengthen their supply chain. I think over the next few years, we'll see diversifying outside of China. Now, will that be to India if we can pull off a 0% tariff agreement? Yes. Will it be back to the US on the margin? Yes. Will it be into the USMCA in Canada and Mexico? Yes. Again, there's no absolutes, but everything on the margin in my mind over the next few years is out of China into the rest of the world. And companies that are in China will pursue what I've heard through the first quarter is a China for China strategy. It'll be okay for a US manufacturer to produce in China, but they'll be selling to China domestically with that production or perhaps potentially serving goods that don't come back into the US. So yes, I like companies that have a strengthen their supply chain, diversified to countries where we can negotiate preferential trade deals, and we're on that path. And I do think domestic investment is going to go up. The signal is clear that that's what the U.S. wants. Now, whether it's dual sourcing, I'm not sure. I'm not sure it's iPhone production, but there's as far as the automotive industry, I listened to the GM CEO yesterday. There's a lot of excess capacity in the automotive supply chain, right? Because over the last few years, it's all gone overseas. Some of that can come back without new plants. Across the industrial base in general, there's a lot of capacity. I have companies saying we're about 72, 73% of capacity. So we don't need new plants to increase production 10, 15, 20%. So the thought that we have to build greenfield to bring production home, yes, for the long term, but in the short term, you can bring some home. So incrementally, I think we can see at least dual sourcing or critical parts come home quick and have some quick wins. So I am looking for companies with a U.S. supply chain and that have diversified away from China.
Can you give us one example?
Well, the companies that I've heard so far have been microcap, and I don't really want to mention them.
All right.
So,
Well, let's talk about some perhaps recession-proof sectors. That the recession word has been on people's radar. Even JP Morgan has recently, or JP Morgan and Goldman Sachs in particular, have raised their odds of a recession to 45% recently, up from, I believe, 35%. And a lot of economists are talking about that. If we get a second quarter of negative GDP, then that's technically a recession. What, if anything, hedges against an economic downturn? Traditionally, Walmart has done quite well. If you look at all the past recessions, except the one in the early '80s, it's outperformed the market. So, are you looking more into staples, utilities? How are you getting defensive if that is your play?
sure. Look, the consumer is a risk, and I think you mentioned it from two sides. One, if there is a recession, or if people fear recession, right? I mean, fear creates reality, right? If you start worrying about a recession, you're going to cut back spending on the margin. That can affect the consumer sector. Also, a lot of the stuff in the consumer sector comes from overseas, from China and from Asia, for lack of better words. A lot of the consumer products we get, so prices can go up a lot. So I think prices can go up, and so that sector is going to be dicey throughout all the names you've mentioned, and it's not a place where I would want to allocate a lot of capital. As far as utilities, look, yes, I think there are utilities that are benefiting from data center growth, that are benefiting from natural gas growth, that are benefiting from rate cases, and they've got pretty decent yield. So I would worry about utilities that operate in areas where there could be forest fire risk, because we've seen lawsuits following fires that can kind of not be great for investors. But there's a bunch of others: natural gas pipeline companies, a lot of that stuff's buried, water utilities that look interesting. Those aren't going to be home runs, but you can pick up decent yields and maybe some capital appreciation along with rate-based growth. Again, I mentioned aerospace and defense. If we get a recession, I'm not sure that spending slows.
Are you
Just
expecting the
geopolitically,
government to hand out more contracts? Is that part of your thesis?
more contracts and more goods. Look, for example, the missiles that we sent overseas have depleted our
Mm.
our our inventories of things like Sidewinders and Tomahawks and Javelins and PAC-3 for Patriots. I mean, we sent those to Israel for the Iron Dome. We've sent them to the Ukraine. We've sent them to our NATO allies to replenish what they've moved around. We've moved batteries out of the Asia Pacific theater into Europe to replace what we've sent over. That posture needs to be rebuilt. We're out, and it takes a while. And I think we've seen Raytheon restart production for missiles that are out of production. Just and so they've restarted lines. And then you hear talk of a golden dome in the U.S. for missile defense. There's going to be spending, and not only replenishment, but reprioritizing troop and ship protection. What we've seen through the Ukraine war, specifically in my mind, it's different than it was last time. And I think the Army and the DoD knows that. And that's where the spending has to come through. So I think you'll see new procurement. I think you'll see replenishment. And it'll be hard to cut that, especially if this, Putin doesn't want peace. It doesn't seem like he's going to sign a peace deal. And she keeps saying they're going to take Taiwan at some point. We can't have zero inventories right now. Unfortunately, of course, I'd like to see peace. Of course, I want peace. But if you're just looking at it from a revenue perspective, the visibility of spending for the next year or two looks pretty good.
Are you ready to meet the biggest minds in Bitcoin face to face? Well, this summer, the crypto capital of the world isn't Silicon Valley or New York or even Miami. It's Las Vegas, introducing Bitcoin Vegas, the ultimate Bitcoin event of 2025. And this is not your average conference. Join real conversations with people shaping the future of money. Thought leaders like Michael Saylor, Lynn Alden, Ross Ulbricht, Winklevoss twins, David Sachs, and many, many more. Whether you're a hodler, builder, or just Bitcoin curious, BTC Vegas is where ideas ignite, partnerships form, and conviction grows in the space. Tickets are going fast, so lock in your spot today using my link down below or scan the QR code here. You'll get a 10% discount. Get it before tickets are sold out completely. We'll see you in Vegas. I guess, is it fair to say that your underlying assumption behind what you just said is that we're not going to get a resolution in Ukraine or the Gaza Strip anytime soon?
No, I actually think we will get some sort of resolution. I think they'll get there, and I hope so.
Hmm.
That said, the supplies have been sent overseas. It's a replenishment. I mean, we have to replenish the vehicles we left in Afghanistan. I mean, there were a considerable amount of gear, and I'm not talking politically. I'm just saying the gear is gone, and the army needs to rebuild it. The missiles that we sent over to Israel and Ukraine are gone from our stockpiles. We need to rebuild. We've sent cluster bombs overseas and 2,000-pound bombs because we don't have the things they're asking for. It's crazy that our stocks are so low. So there's this replenishment that needs to happen. There's also the refocus and the pivoting to the new threats, I think, of drone warfare that have emerged, and seeing just exactly what missile and drone warfare would look like in the future. And I think the DoD needs to get there from a defensive and offensive capability. So it doesn't. I hope these conflicts get settled, but again, the spending needs have already been put in place in my mind.
Let's shift now to the tech sector. So take a look at this article from the Wall Street Journal. What big tech has going for it in the trade war. This is interesting. Apple, Microsoft, Amazon, Google, and Meta posted collectively around $450 billion in revenue for the March ending quarter. That was up 10% for their combined revenue the same quarter last year. Of the tech giants, Apple and Amazon are considered the most exposed to tariffs. Both issued slightly disappointing projections for June, but still it says even Apple and Amazon have many levers they can pull to ease the pain that tariffs pose. Apple, for example, is moving more of its production out of China and will ship most of the devices sold in the U.S. from manufacturing facilities in China and Vietnam. Do you think big tech, the Mag 7, are insulated more or less from tariffs, meaning they have so much buying power to their suppliers that it really doesn't impact them so much?
No, I don't, is a broad statement. I think you have to look, the Mag 7 as a group is about 30 to 32% of the S&P 500. In general, I think it's kind of overvalued, and I don't think it provides diversification when you look at it from an ETF standpoint. I don't own Amazon or Apple, so my comments, will stay high level on those names, but they're product-driven companies in a way. I mean, AWS, the web service, isn't, but Amazon has a big consumer footprint, and Apple sells product. Yes, it has, I understand, the services universe that's a powerful part of Apple, but they both sell some products. And so they've got sourcing issues. Not only can they get things, but what's the price? The AI-driven part of the Mag 7. Look, I think AI will be more revolutionary than the internet, as far as, like, if you're thinking back to the 2000 period of when the internet really flowed in with fiber optics and everything else. It was a massive change. AI, I think, will dwarf that. I've seen AI incorporated, into my workflow already, as far in everybody's workflow, from students to anything is reviewed by AI. If you write something, dump it into AI and say, can you make this more conversational, right? And then the thought of autonomous driving, autonomous robots, it's a game changer from a productivity sort of view. Um, that might help us bring production home. I mean, I don't think Apple's going to build phones in the US, but if you're building them with robots in China or robots in the US, maybe you are cost competitive. I don't have a view on that. So I do think part of that Mag 7 leads in the AI space, and there's real opportunities there. I don't know if the stocks themselves already discount it. I think you have to have multi-year success in revenues and earnings to justify the valuations, albeit that might come true. I think there's a lot of areas up and down the market cap where you can get good exposure to that theme without having to pay those multiples as well.
You wrote to me in a note offline that you think this pullback may present a good buying opportunity, given that valuations could look more attractive. How would you evaluate valuations overall for the broad market? Any specific sectors that stand out as being undervalued or overvalued?
Well, sure. Look, in general, the larger you go, the larger cap, in my view, the more overvalued you are. And I think you said it. Is there more certainty? There's more defensiveness.
Mhm.
I'm not sure. I think there is perceived defensiveness. As you go down cap, I see a lot of undervaluation. I see a lot of neglect. I've got companies that are probably below the market cap radar that we can talk about that are net cash, that are growing earnings, and that play into some of these areas. And they're trading at significant discounts. If you look at banks, for example, regional banks are cheaper than the large cap peers. And I think it's a perceived safety of balance sheet, although I'm not so sure there's a big difference. So I think if you move down cap and away from this ETF driven mantra that the whole world is in, and do some individual research, you can see some undervalued opportunities. And owning the market. What is the market? Is the market the Dow? Well, no. Is it the S&P 500, which is dominated by seven stocks for 32% of its weighting? Well, not really. What is the market? And furthermore, in a strategy where you're going to own plus or minus 30 names, I don't own the market. I own a concentrated portfolio of stocks, and hopefully, those can do well ambivalent of what the market does.
Interesting. Tell us about your preference for small versus mid versus large right now.
Well, I'm a behavioral investor as well. So, I think we already talked, the market craves clarity and certainty. As you go down cap,
Yeah.
there's less sell-siders following any given stock. Um, some have none, some have two or three. You don't have the multi-divisional companies where the revenue stream can be, a little bit more predictable. You can look at the subsectors and there's more cyclicality going down cap. And I think, one of the knocks I've heard going down cap is if you look at, for example, the Russell 2500, oh my goodness, one of the benchmarks I use for my SMID value is the 2500 value. And there's about 1,800 plus or minus companies in that. It's a subset, the value versus the growth. And I hear people saying you can't invest in that index because there's 600 companies that lose money. Well, sure. But there's about 11 or 1,200 that make money. And so that's a pretty good place to hunt. If you don't, or if you aren't caught up in this ETF mentality where you have to buy a sector or you have to buy an ETF, if you can buy a company or a handful of companies that are actively selected, I think you can assemble a portfolio that looks very different from an ETF, that can get interesting from a valuation, from a neglect point of view. And I personally believe buying low expectations is as important as buying low valuation. So not only buy low, sell high on valuation, but if you buy neglect, meaning people have given up or don't understand, or maybe there's some bad news if that can revert to positive and high expectations over 2 years, that's a powerful driver as well as earnings and valuation and PE and other sorts of multiples.
You also commented on the financial sector to me offline. Let's talk about regional banks. There was trouble with regional banks a few years ago, as everyone is aware. How is that sector holding up now, and how are you looking at that sector?
So the results have been good across the board. And I think, again, it's a space I see rampant with neglect. I mean, look, if we go into a recession, we'll see losses in loans and banks will put up losses. I'm not sure we're in a recession. I'm not sure we're in a durable hard recession.
Hmm.
But I think people remember the financial crisis, where banks really took it on the chin from 2007 to 2009. But banks in general, since that time, have tripled their capital levels. And love Elizabeth Warren, hate Elizabeth Warren, but she and the other regulators have forced banks to really increase their capital. And I think you can see banks with tier one capital of 11% or so. Regulatory minimums are 8, and those minimums are strengthened well over what they were during the financial crisis. Now, going back a couple of years, Silicon Valley Bank, it's unfortunate that you use the word bank with that company. It was really a private equity venture capital firm, and its balance sheet was not structured the way most banks are structured. They weren't matching their assets and their liabilities, and that's where they ran into a problem, and it set off a panic. So you have this fear in the marketplace, whereas right now the banks aren't showing a lot of losses. They're well reserved. They're putting up loan growth. Their deposits are in excess of loans. So you're not going to, at least in the near term, have a deposit crunch. They're paying decent dividends and they're trading at book value in a lot of cases, under book value in some cases. Yes, a little premium to tangible, but not too bad. And it's an area where deregulation can kick in to maybe alleviate some of the reporting requirements that are handicapping banks. And also perhaps merger activity accelerating. I own 2 banks that have done mergers in the last 10 days, and both of them look like great deals that are very accretive to EPS going forward. And I will say on mergers, bank mergers have generally been successful. There's a lot of cost reductions, from your reporting systems and your capital systems. You pull out one system and put all the data on the other system, there's a lot of cost cuts that can happen. So, and remember, the loan growth has not been there for banks recently. It's been captured by these private credit BDCs, which are unregulated, which are highly levered in some cases. And I'd look there for credit quality problems first, because the banks haven't been taking that business. One, they haven't really been allowed to from a regulatory perspective. And 2, they've been building up their capital and just not competing for those loans because they can't compete with the leverage ratios, even if they wanted to, which most of the ones that I'm looking at have very disciplined credit review processes. So I think they're cheap. I think recession could be a risk, but that said, maybe at 9, 10 times earnings with 4% plus or minus dividend yields,
So
I think we're already pricing some economic weakness into that group.
if I understand correctly, and correct me if I'm wrong, you're approaching this from a valuations and potential M&A angle. I mean, like you said, the loan book isn't getting better, and in fact, it'll probably be shrinking during times of economic distress. Credit delinquencies may go up, so they may see more write-offs on loans. It's not a growth story for banks. Is that kind of the approach here?
Not necessarily. Loan growth, some of the banks I look at are projecting 4 or 5% loan growth this year as the economy continues to
Loans
do
to whom?
well. Commercial real estate,
Okay.
homes, not so much the consumer, corporate and industrial. And maybe if these BDCs and levered credit funds back off a little bit, and there's also a lot of these banks have relationships where they manage the deposits and they can grow loans along with their customers. So, 4%, 5% loan growth is not heroic for a bank by any means.
I see.
and the loan to deposit ratios look pretty good, meaning more deposits than loans, so they can fund themselves without using the Fed. They're not upside down, in that sense. It is valuation to some extent. It is neglect and low expectations to some extent. Yes, mergers can help if you get them over time. Um, and then hidden assets can help as well. And just, I think, remember, the regulatory regime has shifted, and there's something called CECL, not to bore you, but a bank has to look at its loan book in general and price its losses to what it thinks total losses would be over the life of a loan given an economic scenario. The banks are generally conservative, and some of those banks, said differently, have already taken loan loss reserves that would assume a period of accelerated economic weakness. So if we see that, you won't see charge-offs running through the income statement at a more aggressive pace than you've already seen. You'll have to see a more aggressive weakening of the economy.
Yeah.
Said differently, they front-loaded the losses, and they still have capital ratios of close to 11%. And as I said, the banks really, their balance sheets are underappreciated in my mind by a lot of the investing public versus what happened in the great financial recession, for sure.
Okay. Let's sum up what we've talked about and kind of give an overview of your investment philosophy here. How do we package everything for the investor who may be interested in learning about your strategy here?
Sure. So my philosophy, 3 points. One, financial strength. Have a strong balance sheet. Don't have off-balance sheet leakage, environmental, pension, lawsuits that can strap you. And if you have a strong balance sheet, you're not going to be forced to go hunting for debt or equity support in a weak market. In a way, that's what I tell my clients. Have a year of cash or near cash so you don't have to sell stocks in weakness, and you can be opportunistic over this time. So the first platform of my philosophy is financial strength.
Yeah.
The second, and this differentiates me from a lot of value investors, is the ability to grow. I will not own a company that I don't think can grow revenues and earnings over my 2 to 3 year investment horizon. Value is not the opposite of growth, David. The opposite of value is overvalued. The opposite of growth is shrinkage. I want to buy things that are growing. I just don't want to overpay for them. And I think I can find plenty of opportunities. So that ability to grow revenues and earnings over an investment horizon through my active due diligence is what I look for. And that's where I spend a lot of my time. And the last is valuation. Don't overpay for something. Have a 2 to 3 upside downside trade-off. There we go. And hopefully at least a 30% CAGR over my 3 year window. Again, if you can build a portfolio of stocks like that and diversify it, hopefully we can do okay over time.
Yeah.
And again, I would
Are there
stress I would stress time frame. A 2 to 3 year time frame is a big ally for investors versus trying to be day to day or month to month.
Fair enough. With the unjust valuations, are there specific metrics that you consistently look at, or is it sector specific?
Well, yeah, I mean, I like, as I said, ROIC is kind of,
Yeah.
where it all comes down to positive free cash flow, ROIC. The ROIC, you want your return to be over your cost of capital. I mean, that's all that really means. So your returns on your investment are greater than your cost of that capital as a company. That goes really for any financial asset. I will look at multiples, either PE or EV to EBITDA, or price to book, but I'll triangulate those and I'll look at discounted cash flows. If something, and they should, if done correctly, all kind of triangulate to the same area. And there's information to me if they don't, if one of those metrics is off, it's a case where I'll spend some time exploring why. So, look, if I'm looking at a utility, of course, you'll probably have to, take a longer time horizon because it's more stable and the regulated base provides a little more visibility. A smaller, more cyclical cap, um, I think you have to have greater discounts in your price targets to make them attractive. So by sector and by company, it's a utility with a 20% upside. It can be attractive to me as a small cap that I think that can double over 3 years.
A long time ago, in my past life, I applied to work at a hedge fund. I didn't get the job. That didn't work out, which is why I'm interviewing fund managers now for a living. Anyway, the the interview question that was asked to me was if you were given the three statements: income statement, balance sheet, and cash flow. What are three metrics you would look at first before you look at any notes to the financials, any MDMA, any other news? Just three financial metrics. And apparently the correct answer, and I'd like you to evaluate this, apparently the correct answer is number one, revenue growth, number two, ROIC, and number three, leverage, whatever leverage ratio you want to look at. Does that make sense to you?
Well, no, it's not my philosophy. I mean, look, people who do that operate on a shorter time frame, and maybe a day time frame, and they might be hedged, right? And so if you're looking at revenue growth, you're a short-term investor. I think the third one is where I would start: the leverage and the strength of the balance sheet.
Okay.
Not only net cash, but your interest coverage, and the quality of your cash flow are important. Where is it coming from? And looking, as Warren Buffett would say, companies should be spending capex in line with DNA, and if not, understand why. And this is over a longer period of time. If you built a factory 2 years ago and you're trying to fill it up, you may have had capex high a couple of years ago and it's lower now. So normalize it over time. The second thing I would look for, is quality of the cash flow statement. What if you have an acquisitive company that's constantly taking write-downs of goodwill, that's a warning sign. It means they've been overpaying or the acquisitions aren't working. So there's a lot of information on the balance sheet and the cash flow statement that to me is very important before you get to the income statement. And I like a strong, don't get me wrong, I like a strong income statement. I like revenue growth. I like earnings growth. I like margin growth. But you need the fundamentals. You can't just look at revenue growth and say that's fine, because you could be highly levered, you could be free cash flow negative, and you could be buying market share. And to me, that's not a situation that would work over a 2 to 3 year time frame. So I look at it from the lens of a value investor, and I think most hedge funds would not operate through that lens.
And just as a general philosophy, how important is it that the company uses its cash primarily for ROIC? I mean, do you mind if they use it for share buybacks or dividends?
No, it's incredibly important. I think to have flexibility, and I think buybacks opportunistically can add a lot of value. But that said, it's the word opportunistically. I personally don't like companies buying back stock at 52-week highs. I tell companies to approach repurchases the way I approach stock selection.
Yes.
If you've had a bumpy quarter, if your stock is sold off, and I'm on the call or listening to the call, and they say it's temporary or we're going to revert and our margins are going to strengthen and the problem we can fix, and the stock's way down, that's the time to buy your stock and measure your stock repurchase return against an acquisition. Because with stock repurchase, there's no second set of books or third set of books. There's no skeletons in the closets. There's no integration risk. If you're the CFO, you should know what your corporation looks like and have high conviction to buy your own stock. I also look, and I think companies that buy stock, I think the management team and the board should be buying stock. And it frustrates me that a lot of times you don't see that. That's another thing I would look at. The management's going to pony up and invest alongside me. It makes me feel better on the margin.
Okay. And then finally, just on management, what do you look for when you're reading management's bio?
I really look for the lens of the ability to grow. They understand their business, they understand their markets, they understand the competitive position they're in, and they have a roadmap to growth. And that's kind of my investment case. And as soon as I get that case of why it could go right over 2 years, I'll start tearing it apart and say, why can't it go right? And where might I be wrong? And the more I can't prove myself wrong, the stronger investor I'll be. Look, this concept of a great management team of a stock at a 52-week high, you could have a great management team at a stock at a 52 low because that's where they're going to add value. That's where they're going to prioritize CapEx, buy back stock, invest, reshape the company, and create value going forward. And if a company, just because a stock is high doesn't mean the management team has been doing the right thing. It can, and a lot of times it does, but I don't think just a high stock price equals a good management team or vice versa.
Excellent. Chip, great interview. Where can we learn from you and study your work?
You could check out my website, reweyassetmanagement.com. That's Rewey. It's pretty long. And I'll post on LinkedIn sometimes. But
Okay.
David, thank you for the opportunity. Great conversation. I like talking to you.
Yeah, thank you as well. And we'll put the links down below, so make sure to follow Chip there. We'll speak again next time, Chip. And thank you for watching. Don't forget to like and subscribe.